Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to a research webinar discussing our expected performance for EXPOLANKA Holdings PLC during the third quarter of financial year 2022. We are pleased to inform you that Capital Trust Securities was ranked number 1 for the calendar year 2021 in terms of transaction turnover, brokerage turnover, and number of transactions. Capital Trust Securities is also ranked number 1 for the financial year 2021-2022 so far in terms of transaction turnover, brokerage turnover, and number of transactions. It is indeed a milestone as 2021 is the year in which the Colombo Stock Exchange recorded its highest ever turnover so far. We wish to also kindly remind our clients that during the period 2010-2011, when the Colombo Stock Exchange recorded its highest ever turnover up to that period, Capital Trust Securities was also ranked number 1 in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 27th of a continuous series of webinars. Capital Trust Research Private Limited has been at the forefront in correctly identifying early and recommending stocks through its webinars and comprehensive research reports. Even during pandemic conditions, the stocks recommended by Capital Trust Research through its webinars and research reports have generated over 638% total return from 1st January 2021 if bought proportionately to their market caps. We are very happy to reiterate that we have guided our clients to buy and continuously hold on to the stocks we have recommended, thereby generating enormous total returns for them, also while keeping the Colombo Stock Exchange very active. Now we are pleased to introduce Mr. Hasit Aliyanege, Head of Research of Capital Trust Research Private Limited, and Mrs. Divya Kasi-Chetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. Over to you, Divya.
Thanks, Prashani. We must remind our clients that we published our first report on EXPOLANKA PLC on 30th November 2021, when the stock market price was only at 27 rupees. We believe it is the right time again to provide an update on the performance of EXPOLANKA PLC, given the significant changes in the operating environment over the last few months. We will also discuss several important points on the strategies adopted by the company to maintain long-term sustainability of growth and earnings, as many critics say freight rates will decline in the second half of this year. As I'm sure you all know, EXPO's business segments consist of logistics, leisure, and investments. The logistics segment contributes 98% of revenue. Now let's take a few minutes to look at what's happening with the industry dynamics and rates. Industry experts expect rates to continue to remain high throughout calendar year 2022 and on to first half of calendar year 23. This is owing to the ongoing challenges faced in securing ocean capacity amid current logjams and COVID-19 related delays. Countries like China are still maintaining its zero COVID strategy, which will likely cause port shutdowns and delays, which in turn would keep rates elevated throughout the next 18 months. Plagued by vessel bunching and terminal congestion and equipment shortages for much of last year, North America's West Coast is likely to face further delays. And the challenges will go well into 2022, even if imports slow down from the double-digit gains in 2021. The 24 hours operation of US West Coast Port Gate is insufficient to solve the current backlog in shipments. According to EXPO's president of the Americas region, new variants of COVID is expected to continue to cause supply-side constraints and delays at ports, airports, and warehouses. The head of supply chain at Drewry Shipping Consultants mentioned that rates will not normalize until the current systemic market disruptions and crisis in container shipping reduces significantly. He even expects an increase in rates by over 60% in 2022 on major routes compared to 2021. Even with a shift in consumer spending, the low retail inventory levels will result in strong demand by retailers to replenish their inventory. and therefore keep cargo volumes elevated between Chinese New Year and peak season 2022. Let's take a quick look at what's happening with the ocean rates on one of the main trade lanes. Ahead of the Lunar New Year, spot rates out of Asia have started to climb. Looking at the graph, the ocean freight rates for Asia-US West Coast increased 7.4% week on week to 14,637 per 40-foot container. This rate is 181.2% higher than the same time last year. Asia to US East Coast weekly prices climbed 4.7% to $17,488 per 40-foot container over the week. This was over 214.5% higher than rates recorded during the same week in 2021. The rates remain elevated, although the prices on both lanes remain 20% below peak season highs, which was hit in September 2021. The bump in pre-Lunar New Year demand comes with no significant easing in congestion at the major port of LA Long Beach. The latest demand projections continue to show volumes to remain strong, with Omicron spread likely to keep consumer spending on goods above pre-pandemic levels. Freightos.com marketplace data show that average monthly end-to-end transit time for China to US ocean shipments hit a record of 80 days in December 2021. This was 50% longer than in December 2020 and 85% longer than in 2019. Delays are expected to persist considering the ongoing supply-side disruption. The table reflects the spot freight rates across 8 major trade routes. As you can see, the rates across 7 of these major routes have increased substantially over the previous year. According to Drewry's supply chain advisors, spot freight rates for Trans-Pacific lanes have increased continuously for 7 weeks. Drewry's Composite World Container Index increased 1.6% to $9,698 per 40-foot container for the week ending 20th January 2022. This is 82% higher than the same period of last year. At present, the container rates are high and the schedule reliability for ocean freight is at an all-time low. Ocean carriers are transferring capacity to the Trans-Pacific trade lane and the Asia to Europe trade lane. Port congestion and vessel delays are soaking up supply, with more than 10% of the global fleet at anchor due to delays. The rates are expected to remain elevated throughout calendar year 22 and first half of calendar year 23. DHL Ocean Freight Market Outlook 22 to 24 stated that the container vessel order book are at the highest level in 10 years, with majority of these vessels being built in China. New capacity is expected to enter the market only in 2024. When the availability of this equipment has improved and global port congestion has eased, freight rates are expected to gradually stabilize. However, will be far higher levels than pre-COVID days. Air freight rates remain stable, but still very elevated in what is typically a slow period for air cargo. Recent cancellations of passenger flights, including travel bans imposed in Hong Kong and elsewhere due to the Omicron surge, will further restrict cargo capacity and help keep rates up. The graph captures the Freightos Air Index global average rate. As reflected, the rates continue to remain elevated and recorded at $4.3 per kilogram for the week ending 16 January 2022. This is a 9.1% increase over the same period in 2021. The logistics segment of EXPO contributes 98% of their revenue. Close to 95% of revenue comes from overseas market, with Sri Lanka only accounting for less than 5%. Therefore, EXPO is unique and will benefit significantly from the imminent rupee depreciation. Further, as only 5% of revenue is from Sri Lanka, only this component will be subject to changes, if any, in the Sri Lankan tax structure. 63% of EXPO's total revenue is from its US subsidiary, while US trade lane accounts for 75 to 80% of total revenue across all its subsidiaries. Europe accounts for 15%, and the balance comes from Asia. Now let's take a few minutes and review the key strategies adopted by the group to deliver strong profitability over the last year and the first half of financial year 22. The group recorded strong performance in financial year 21 and first half of financial year 22, mainly due to the long-term strategies adopted. Although elevated freight rates have positively contributed to the growth in profitability, it is not the only element that we should look at. The group focused on consolidating its operations and was successful in growing its key strategic customer base from 10 to over 60 during the last few years. This has resulted in a steady volume growth over the years. The strategic customer base is based on strong relationships, providing EXPO a strong competitive advantage. The model is structured such that the business no longer goes through the seller, but rather the brand. The company has built the necessary capacity with air and ocean liners to serve the customer's demands and also has presence in multiple markets. This provides an edge to EXPO to win over business by providing total logistic solutions across multiple geographies. This strategy will contribute in a steady growth of volumes over the years. The company has focused on organic expansion through investments in people, infrastructure, networks, and presence in key markets. The company has strengthened its network operations in key origin markets in Asia, such as Vietnam, Indonesia, China, and Cambodia, which are all key trading partners with the US, and set up in new markets such as Malaysia and Thailand to take advantage of opportunities in the US and Europe. Through acquisitions, the group has enhanced their service capabilities and offerings, and thereby is able to offer solutions to customers to match their supply chain requirements. Acquisitions is a key long-term growth strategy going forward in order to build capabilities and infrastructure. The company has enhanced technological infrastructure, made digital improvements, and actively adopted technology to bring transparency to customers and achieve operational efficiencies across the logistics sector. The graph reflects the steady growth in volumes on the air freight segment from the start of the pandemic to the second quarter of financial year 22. Although a marginal quarter-on-quarter drop was witnessed in the fourth quarter of financial year 21, in line with the cyclical nature of the business. Approximately 61% of revenue is from air freight during the first half of financial year 22. A volume of 100.5 million kilograms was recorded in the first half of financial year 22, which was a 113% increase year on year. The margins for air freight is generally more stable than ocean freight, as sensitivity to rate changes are generally lower. Port congestions and shortages in ocean capacity has increased demand for air freight, which in turn has resulted in increased prices. The prices are expected to remain elevated throughout calendar year 22 and first half of calendar year 23. Volume growth is the key catalyst for growth in air freight profitability. EXPO expects to enhance volume growth in the segment by focusing on securing capacity through efficient procurement strategies. Draw your attention to this graph. It is evident that from the start of the pandemic to now, EXPO has been successful in steadily growing ocean freight volumes. With EFL developing its ocean freight business and increasing volumes through acquiring new clients and increasing wallet shares, the number of TEUs handled increased by 109% on a year-on-year basis in the first half of financial year 22. 145,000 TEUs were handled in the first half of financial year 22. Customers generally prefer ocean freight owing to the cost being cheaper. As a rule of thumb, the per unit cost of ocean freight compared to air freight is approximately 1:10. However, recent supply chain disruptions serve to increase this ratio of cost per unit of ocean to air to 1:5 during the peak season in September and October. EXPO has built its ocean freight infrastructure with a long-term focus on capitalizing on customers' requirements, building capacity, and further developing this segment in order to serve the growing needs of the customers. It is important to note that pre-pandemic and current air freight yields are largely similar. Yield sensitivity is higher for the ocean segment in comparison to air. However, through increased volumes, enhanced geographical footprint, proper planning, and efficient procurement, EXPO can offset and somewhat mitigate this yield sensitivity. EXPO has proactively adopted various volume growth and yield management strategies. This has been done to ensure the long-term sustainability of profitability at these levels or beyond, even when rates eventually ease in the medium term, when supply-side constraints ease. We must note that just because the pandemic ends doesn't mean that their profit growth stops. The company is focusing on fundamentals to reduce earnings volatility in the future, and we expect a continuation of robust earnings growth. EXPO has evolved into a leading market player and has been successful in building capacity across both air and ocean liners over the last 2 years. This is being done in order to serve the needs of strategic customers by offering a diverse end-to-end logistics solution across multiple geographies and securing large volumes. They differentiate themselves from the competition through an enhanced service offering and has evolved into a total solution provider. EXPO provides bonded warehousing, trucking, and other value-added services, which will contribute in maintaining yields per kilogram across ocean and air, even when rates ease. Organic and inorganic growth has supported geographical expansion and presence across multiple markets, thereby eliminating the need for intermediaries, which has contributed in strengthening EBIT margins, as EXPO is able to control both legs of the transaction and enhance the profits earned. EXPO continues to focus on multiple strategies to mitigate supply-side disruptions. These include increasing volumes through widening of strategic customer base, effective procurement planning by leveraging off the brand they have built over the years in order to gain capacity and increase their bargaining power, considering the significant volume of business handled through them, actively looking for mergers and acquisitions to supplement service offering and enhance margins and further widen global reach. The company follows a stringent process and a detailed due diligence study when looking at potential targets. The process takes several months or years as they need to identify the right target at the right time at the right price. And most importantly, it has to be a strategic fit. The benefits of the acquisitions are not short-term, as they are generally strategic in nature and therefore will contribute to the long-term profitability of the company. EXPO is open to opportunities to consolidate operations via acquisitions in Europe and Africa. In order to support their growth, they have taken the necessary steps to enhance working capital, including improving asset quality and strengthening their balance sheet. EXPO is able to obtain cheap sources of funding through its parent company and other commercial banks based on the strength of their balance sheet. Let's take a few minutes to discuss what makes EXPO stand out and what their main competitive advantages are. Their strength is their presence in origin markets across the Far East, where USA's main trading partners are located. This has given them a significant edge to win over new business and acquire new customers deepen wallet share, and enhance profitability by capturing both legs of the transaction. The operational model of the company is a key factor to consider. The company operates an asset-light model with low fixed overhead costs. Therefore, when you scale up as volume increases, you don't need to increase fixed costs proportionately as operating leverage comes into play. Therefore, as you scale your business, the yields improve and profitability is further enhanced. Over the years, EXPO has built enhanced capacity with air and ocean liners. This has been done by leveraging off their brand and strong volumes recorded in the recent past. They have strong negotiating power with both air and ocean liners and strive to serve their strategic customers' growing requirements. As you are aware, EXPO is backed by a strong parent company, SG Holdings. The group provides integrated solutions from procurement outside Japan and international logistics to last mile delivery to consumers. The company has a global network of 28 countries and regions, including North America, Europe, Asia, and Africa, with over 120 companies within the group. Through the parent, the company has access to cheap sources of funding and relationships with carrier partners. As mentioned previously, the company has made investments in technology to drive growth and transparency. The company is actively looking at acquisition opportunities. The benefits of these acquisitions takes a year or more to materialize and will support the long-term profitability and growth of the company. Over a period of time, the acquisitions result in an increase in volumes, improvement in product and service offering, and thereby contributes to enhanced margins and increased profitability. EXPO owns and operates over 70 offices in 32 countries in major trading hubs. The company has extensively invested in human capital and infrastructure in the region. As mentioned before, owing to its presence in the Far East origin destinations, EXPO has the ability to cater to a larger customer portfolio by increasing the number of key strategic customers and broadening operating verticals. EXPO's strength in key source markets have enabled the company to offer end-to-end solutions, eliminating the use of intermediaries and thereby improving scale and profitability. As mentioned before, EXPO adopts an asset-light operating model, enabling the company to scale its operations and grow volumes without incurring significant additional fixed cost. This will result in higher yields and stronger margins. Over the past 2 years, EXPO has strengthened its infrastructure, personnel, and balance sheet to achieve strong volume growth and has the fundamentals in place to keep scaling up. As the company scales its operations further, working capital requirement also increases. EXPO's working capital funding needs are expected to be met by its parent and commercial banks in different markets based on its balance sheet strength. As mentioned previously, the increased volumes and scale is expected to result in stronger EBIT margins. EXPOLANKA is backed by its strong ultimate parent, SG Holdings, a much sought after stock for those who trade in stocks globally. The company is a leading logistics conglomerate headquartered in Tokyo. The company is listed on the Tokyo Stock Exchange and is included in the TOPIX and the JPX Nikkei 400 indexes, among others. In addition to delivery and logistics, the company provides real estate development and management, human resources, and IT consultancy. As part of the group, EXPO receives strategic guidance and access to cheap sources of funding to successfully implement its objectives and drive growth. The parent company recorded operating revenues of $12.3 billion and net profit for equity holders of $676 million for 12 months ending September 2021. SG Holdings' balance sheet is strong, with a net asset value of $3.84 billion as at 30th September 2021. Therefore, EXPO has the strongest holding company when compared to other stocks listed in the CSE. EXPO's continuous investment in developing networks and technological infrastructure has enabled the company to expand its portfolio and establish itself as a total supply chain solution provider. EXPO's technology served to create transparency through end-to-end visibility to customers and operational efficiencies through the standardization of back-end systems across its network. The company continues to develop their ERP platforms, offering integrated solutions within its global network. EXPO's acquisition-led growth strategy has served to expand its service offering and increase value-added services. By enhancing service proposition, controlling both legs of the transaction, the yield per kilogram is expected to increase and further drive profitability. During financial year 21 and first half of financial year 22, the company acquired Complete Transport Systems, Idea Logistics, and several freight systems, thereby creating inroads into the North American domestic logistics market and the Central American market. Immediate network advantages have been brought about through these acquisitions. However, it must be noted that these investments are strategic in nature and is expected to yield results within the next 2 years. EXPO has benefited from having its own companies in the US by profiting from both legs of the transaction on imports and exports. This enables the company to work directly and not via agents. EXPO continues to explore non-organic growth opportunities in Europe and Africa to consolidate its position as a leading logistics player. I will now hand over to Hasita to go through the financial forecast and valuations.
There have been many queries from critics stating there is an increase in total receivables. During the first half of financial year 2022, EXPO's debtors increased to rupees 119.2 billion from rupees 49 billion in March 2021, which represents a 143% increase. When it comes to receivables, the most important indicator to monitor is the number of receivable days. As displayed on this graph, the number of receivable days marginally improved to 57.1 days in the second quarter of financial year 2022. The 143% increase in total receivables is expected given that revenue increased from 75.5 billion in the fourth quarter financial year 2021 to 151.4 billion in the second quarter of financial year 2022, which is a 101% increase in quarterly revenue. As the company is experiencing exponential growth in volumes and revenue, one can expect that total receivables to continue to increase in financial year 22, as it did over financial year 2021. As we have mentioned in our previous webinars, the company extends credit after careful evaluation and a stringent credit appraisal process. Looking at EXPO's customer profile, it is important to note that the key strategic clients are mainly leading global brands listed on the US Stock Exchange. Even during the pandemic period, no client defaulted, which is a testament to the stringent credit appraisal process in place. Given its presence in the US and key relationships, the company is confident of recovering all of the total outstanding trade receivables. EXPO's strategy is focused on efficient procurement of capacity. Given the company's ability to achieve scale through geographical distribution of its operations, EXPO has the ability to negotiate and bulk purchase space on contract rates with large shipping liners and airlines to secure space in advance at attractive pricing. Excuse me. This enables EXPO to canvas business from key strategic clients and increase wallet shares, since it has the ability to provide capacity at competitive rates when other players are struggling to secure capacity. As Divya mentioned in detail, infrastructure development and pursuing M&A activity are two other key strategies followed by management. By building infrastructure and offering value-added services, the company will be able to ensure yields per kilogram are maintained even when freight rates decrease. In addition, by setting up new offices and operations across various origin markets, the company is not required to work through agents, and thus can ensure volume handle will increase further. Through inorganic M&A activity, we expect EXPO to strengthen its position in the African and European trade lanes. Thus, we expect volume growth to be robust in financial year 23. Due to the expected increase in sea and air freight volumes through organic and inorganic growth, as well as EXPO's efficient procurement strategies, we expect EXPO's profitability to increase year on year in the second half of financial year 22 and financial year 23, regardless of the freight rate environment. Having discussed the logistics sector, let's move on to the travel and investment sectors. Let's start with the leisure sector. Classic Travels rationalized its product offering during the pandemic and restructured its cost structures. For the first time since the pandemic, the leisure sector turned profitable in the second quarter of financial year 22. Within the investment segment, management is focused on rationalizing its operations and restructuring its cost base to achieve a turnaround in performance. Once achieved, management expects moderate growth from the sector in the future. As you might be aware, Q3 is cyclically the best performing quarter for the company due to the seasonal demand arising from Black Friday, 11/11, and Christmas sales. Q4 in the past was off-peak for the company, but since US inventory levels are at an all-time low, we expect restocking by retailers to drive freight demand, rates, and volume in the fourth quarter. But having said that, due to the Chinese New Year, trade volumes from the Far East, the US, comes to a standstill for 2 to 4 weeks. As a result, we have conservatively forecast fourth quarter performance in USD terms to be in line with the second quarter, financial year 2022 performance. As mentioned in our previous webinars, we expect the LKR to depreciate to 230 rupees by the end of financial year 2022. It is important to note, it's important that one understands EXPO consolidates its financials in USD on a quarterly basis and then converts it to LKR using the average exchange rate for the reporting period. If the LKR depreciates to 230, EXPO will be required to restate its first quarter to the fourth quarter, financial year 2022 financials. We forecast a benefit of rupees 3.2 billion to net earnings in the fourth quarter as a result of the forecasted rupee depreciation. We forecast net earnings of 22.2 billion in the third quarter of financial year 2022. In the fourth quarter, we forecast net earnings of rupees 13.6 billion through recurrent operations and an additional 3.2 billion through the benefit from the LKR depreciation. Thus, we forecast net earnings of 16.8 billion in the fourth quarter, financial year 2022. We forecast EBIT margins of 10.95 for the third quarter, financial year 22, and a lower 10.78 in the fourth quarter, financial 2022, due to the decrease in quarterly volumes. As Divya mentioned before, industry expects rates to increase and remain elevated across financial year 23, which should ensure no downward pressure on yields. In addition, due to proactive strategies adopted by the company, we expect volume to show robust growth on a year-on-year basis in financial year 23. These two factors should ensure strong profit growth in financial year 23. We have conservatively assumed EBIT margins to marginally decrease from 10.23 in financial year 2022 to 10.11 in financial year 23. We have conservatively forecasted a modest revenue growth of 12% to rupees 759 billion and modest earnings growth of 11.4% to 63.9 billion rupees in financial year 23. As discussed before, revenue in financial 2022 is forecasted at 677 billion and rupees 759 billion in financial year 23. Net earnings to equity holders is forecasted at rupees 57.3 billion in financial year 2022 and a conservative 63.9 billion in financial year 23. The company is forecasted to achieve an extremely high return of equity of 82% and 53% in financial year 22 and financial year 23 respectively. Some investors are concerned about EXPO's high PBV. One should note that due to the extremely high return on equity, the PBV decreases rapidly over the second half of financial 2022 and financial year 23 to reach 10.97 by end of financial year 22 and 6.39 by the end of financial year 23. As stated already, EXPO is a global integrated logistics player with 75 to 80% of its revenue linked to the US trade lane and the US economy. Therefore, when valuing the company, one must understand what its global peers and competitors are trading at. The average forward PER for EXPO's peers is 18.93 times, while the current average PBV is 27.2 times, and the average return on equity is 29.6%. In 2021, EXPO was ranked number 31 in global air freight rankings and number 49 in sea freight rankings. But it's important to note that EXPO is currently trading at a 30% discount to its peers in terms of forward PERs. Also, the company's return on equity is 82.2%, which is 178% higher than peer average. EXPO is currently trading at a forward PE of 13.34 times financial year 2022 forecast and a PE of 11.97 times financial year 23 forecasted earnings, respectively. As stated earlier in the presentation, given the current operating environment, we expect strong earnings growth given that the elevated freight rates are forecasted to continue through calendar year 23, strong growth in sea and air freight volumes, enhanced service offerings ensuring high yields per kilogram, and the expansion of reach through several acquisitions. With over 95% of revenue in foreign currency, the stock provides a natural hedge for investors against LKR depreciation. If the LKR depreciates to 230 by the 31st of March 2022, we forecast FY22 earnings to increase to 57.3 billion rupees. This includes 54.1 billion of net earnings through recurrent operations and a 3.2 billion rupee gain from the forecasted LKR depreciation. We expect the counter to trade at a premium to the broader market PE as it provides investors protection against the performance of the Sri Lankan economy, exposure to the US economy, being a shareholder of a global multinational with robust earnings growth, and being the most liquid stock in the CSC with an average daily turnover of 773 million rupees. As mentioned before, given the current market position, product offering, and revised growth in earnings, we have re-rated the counter. We have assigned a fair valuation based on a PE of 16.94 times. This multiple is based on a 50-50 weighted average of the peer average PE of 18.93 times and the broader market PE of 14.95 times. Based on 16.94 PE on financial year 23 earnings, we arrive at a fair value of 553.25 rupees, providing an upside of 41.5% from the current price. Thank you, everyone. Now back to you, Prashant.
Thank you, Hasita Divya and the research division for your valuable insights. Now, Mr. Rakesh Sharma, Director of Capital Trust Securities, will read out some of the questions that are relevant to many clients, which have been sent through the chat by the audience.
Good afternoon, everyone. Thank you, Ashani. Thank you, Divya. Thank you, Hasita, for your insightful presentation on EXPOLANKA. This has been the most awaited presentation by most of the investors in the market. And those who have invested in EXPO from the day we started recommending this EXPO probably would have made more than 500% return in the CSC. In that backdrop, I would like to ask you the first question. Now, investors are very cautious, and traditional investors are used to PBV of 2 times or 3 times, or even maximum of 10 times. We are not used to we are not used to buy a counter more than 10 times of the NAV. But EXPO is trading more than 10 times of its NAV. How would you like to justify this?
Sure, Rakesh. That's an interesting question. This is a question we get quite often. But what we have explained before is EXPO's operating model is an asset-light model. It's not an NAV based, it's not a heavy asset model. So if you look at the cash flows and the return on equity, which is around 82% this year, and then as per our conservative forecast for financial 23, comes to around 55% return on equity. So that results in a massive increase in book value going forward. So the PBV based calculation is not really applicable to companies with very high return on equities, because it didn't really fairly represent the business. But if you look at the PEs, for example, or a DCF calculation, then you can we feel that's a better representation of the business. And on a PE basis, as we've said, going with a weighted average of the exposed PE average as well as the broader market PE, we are assigned a 16.94 PE on EXPO, and based on our conservative FY23 earnings, we have arrived at a fair value of around 553.25 rupees. So just to summarize, I don't think the PBV calculation is better suitable. This is best suitable for EXPO given its high return on equity.
Right. There's a question from Dinesh Rodrigo. Can you share technical charts relating to EXPO?
Yeah, so that's basically covered on a daily research. I think Capital Trust Research issues it on a daily basis, and it will be sent on a daily basis going forward as well.
Right. Divya, going beyond this EXPO, there's a question from Mr. Mohammed. Do you expect money to flow out of equities due to the recent rate hikes?
So Rakesh, I mean, the recent policy rates, it was increased by 0.5%. And that should actually help in terms of the macroeconomic stability. But we have to keep in mind that inflation in December, in terms of headline inflation, was above 12.1 or 12.2%, right? So when you, and the food inflation was 22, and actual inflation possibly is much higher than that as well. So, you know, we need to keep that in mind. Other than that, the average weighted fixed deposit rate is, as at December, is only at about 5.9. So when you take the tax implication also into consideration, then the return to a fixed deposit holder is maybe 4.9%. So assuming that the return is 4.9% and inflation is at 12%, the real return is actually negative at about 7.3%. So, and we expect inflation to continue to be high. So considering this, we do not expect any funds to flow out of the stock market, given that there are negative real returns that are being generated in fixed income securities. We actually expect the stocks to come into the stock market, because on occasions there has been, I mean, if you look at the Capital Trust Research recommended stocks, the returns are in excess of 640% from the 1st January of 2021. So when you experience returns like that, you would not stay in an instrument that's giving you negative real returns, given the inflationary environment that we're currently experiencing.
So basically, you are not expecting the money to flow out of CSC, even though the interest rate has been increased by 50 basis points.
That's right, Rakesh, yeah.
Right. Um, uh, all right. Okay. This is from Mr. Nalaka Fernando. How does Expo impact if federal interest rate hikes? Not about our interest rate hikes. It's about federal interest rate hikes.
Yeah, so basically, as we said before, Expo is heavily reliant on the US economy and the US trade lane, because that accounts for around 75 to 80% of the volume. So we need to evaluate the impact on consumer demand on various goods and services to see whether there'll be a slowdown in consumer spending. So if there is a slowdown in consumer spending, then we need to see exactly how that will impact exposed trading volumes in the US and uh, see the financial impact. But even though there is a slowdown in consumer spending, as we said, Expo's strategy has been to increase wallet share across its current customers, looking at inorganic growth, looking at building capacity in both air and sea freight volumes. So even if there is a reduction in consumer spending, on a year-on-year basis, we still expect a growth in volume, regardless of the US economy.
And also to add to that, I think what we need to keep in mind is that because of all these congestions and delays in delivering goods, the retailers' inventory levels are very low. So they need to replenish inventory. So that's why we expect cargo volumes also to remain high. So we don't expect a slowdown. That coupled with what Hasita said, all the strategies that they have undertaken in terms of growing presence in markets, controlling both legs of the transactions, having presence in markets where their main trading partner is the US. All of these strategies will help them scale up their business and drive volume growth. So we do not expect a slowdown.
Right. Nalin Prasad asked this question. Newcomers who bought Expo around 400 levels, is there any risk of price being decreased? This is a pure trading question. They're asking whether the price will decrease, those who bought at 400 levels.
So as we said before, looking at the fundamental valuations, the fund, we have assigned a fair value of 553 rupees. But the current trading price will be determined by market forces. But in the medium term, we always expect shares to reflect its fair value. So there might, even if there are short-term fluctuations, in the longer run, we expect it to achieve its fair value and arrive at its fair value, which is 553 in our opinion.
Right. Hasita, Divya, this majority of the investors who are buying Expo always thinks that Expo is a rate-based company, which means that if the freight rates comes down, the profitability will come down. If the air freight or even ocean freight rates comes down, the profitability will get impacted. Can you generalize that with regard to Expo?
Not really, Rakesh. Like we mentioned in the presentation, freight rates are one element that we need to look at, but it is not the only element, because see what Expo is doing and has been doing in the last 2 years is they're getting their fundamentals in place. So through growing presence and by managing sort of end-to-end transactions, by enhancing their service offering and product offering, they are scaling up operations, and their volume growth, both on air freight and sea freight, I think charts that we showed, it's a significant volume growth. So when you look at that, that type of thing, you also need to keep in mind that in addition to freight rates, volume growth is important. The fact that they are able to maintain their yields. So when volumes keep growing, they will still maintain their yields because the fixed cost doesn't proportionately grow. Because operating leverage comes into play. So we cannot only look at freight rates to see whether that will be the only factor that determines their performance. It's certainly not the case. It's a mixture of these multiple strategies that they have been working on and that they will continue to work on. which will ensure the long-term sustainability of their profits, as well as it will reduce earnings volatility as well.
Correct. So Shanta Pereira has asked this question, need to know what is the exposed volume forecast for next few quarters.
I don't have that figure on top of my mind. I think we forecasted for, in terms of revenue growth, I think we looked at something along the lines of 12% for financial year 23, 12% year-on-year growth. And for financial second half, I can't really remember the figures. Is there in our presentation? We can just have a look at that, where we stated the revenue as growth, revenue figures for Q3 and Q4.
Right. This Hasida and Divya, this is a very particular question that I would like to ask. Now, if you really see for last 1.5 months, Expo has been trading in between 370 to 400 levels. There has been a widespread speculation from the investor community that high net worth individuals who are willing to sell are waiting for our webinar to sell out their stakes or dump the shares. This has been the speculation in the market from yesterday onwards. Would you like to make any comment with regard to that?
So we actually have no visibility on that side as though the investors' intentions in terms of exiting certain counters, but looking at what they've done so far, where they've entered from very low prices, they've been waiting for the share to achieve its intrinsic value. And as we said today, the intrinsic value is not 400 rupees, it's 553 rupees. And that's without accounting for inorganic growth and various other expectations, market expectations in financial year 23. And even our financial 23 projections are very conservative. As Divya mentioned, rates are expected to increase in financial year 23 compared to financial 2022. And yet in our projections, we have marginally reduced the EBIT margins. When the company increases its volumes, EBIT margins should actually increase. But we have taken a conservative view on that front. So our financial 23 figures are quite conservative, and still we arrive at a fair value of 553. So which is a 41% upside to current trading price. So, but ultimately entry and exit depends on the investor's appetite. But looking at the strategy followed so far, they might actually hold on a bit longer.
Correct. There's a question with regard to BIL, Brown's Investment. This is from Mr. Pires. BIL has received the much awaited board seat in HNB. Is there a large increase in the profit after tax in the current financial year?
So Rakesh, actually BIL is the single largest shareholder now of HNB. They have 9.9% of voting shares and 45% of non-voting shares. So with this board representation, they have significant influence where they can, sort of influence capital changes, block mergers, things like that. So because of that, they can consider this an associate company going forward. So, I mean, if you look at it, okay, the benefit to their P&L will come in two ways. There will be a one-off like a bargain purchase gain, which will come above the profit before tax, which will amount to roughly about 17 billion rupees, because they bought this way below the net asset value. In addition to that, also, I mean, if you look at sort of the regular profit that HNB is making, I think in the first half, they made about 9.4 billion rupees. So assuming they make about 18 billion rupees for this financial year, then also another 3 billion or so will be brought into BIL's P&L. So, by getting this board representation, there is significant gain in their P&L, which will come into play in this financial year.
This financial year means 2022 March results that you are right. So your bargain profits will be coming into the financial statements in March 31st, 2022 figures.
That's right.
Right. Right. So basically, BIL can consider HNB as an associate company.
Yeah.
Okay. Right. There's another question from Mr. Ganganath. Assuming the rupee depreciation happens within the year as expected, when will the revaluation benefit be realized in the financial? This is with regard to EXPO.
So,
sorry, go ahead.
So if the rupee depreciation happens within the financial year, then what happens is the P&L is essentially sort of restated. So you look at the mid exchange rate, and all even previous quarters will be restated. And by end of sort of assuming that the rupee depreciates before March, then this gain will come into the P&L by then.
Yeah, so we are assuming in our projections what we stated was there's about a 3.2 billion benefit coming into EXPO if and when the rupee goes to 230 rupees by March.
Right. Divya and Hasita, there's another question that this is a question for the most of the investment advisors as well as for the investors. A lot of investors have gone the above limit, single share limit of 30% for EXPO at their respective margin trading providers. What should they do?
So I think a strategy followed by quite a few, and I think Capital Trust has been advising their clients as well, is to always have multiple margin providers and move the excess to a different margin provider. So that way you don't really need to sell even if your exposure goes above 30%. You can use multiple margin providers and still hold on to the shares, which is trading at a significant discount to the fair value rates.
Right. I think since there is no more questions, I think we will have to wind up this Q&A session. Thank you, Hasita. Thank you, Divya. Over to you, Prashani.
Since there are no further questions, I would now like to close the webinar. We want to keep our webinars concise and relevant, but we assure you we will be back soon. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you to our valued clients for their support and continuous trust in us, and to our staff who helped to organize this webinar. Thank you very much. Have a nice day.